In today's video, we are doing a deep dive into e-commerce business accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. E-commerce involves buying and selling goods or services using the internet. In India, the e-commerce industry is rapidly growing, with major players like Flipkart and Amazon leading the market. This growth is driven by increased internet penetration and mobile usage. Understanding this sector's dynamics is crucial for accounting, as it involves complex transactions across various platforms. Flipkart makes money through various revenue streams such as sales of products, advertising, and commissions from third-party sellers. Major costs include inventory, logistics, and customer acquisition. Understanding these streams and costs is vital for accountants to accurately record transactions and assess profitability. This model emphasizes the need for precise revenue recognition and cost allocation, especially in periods of rapid growth. In e-commerce, departments like finance, operations, and procurement play significant roles. The finance team manages cash flow and prepares financial statements. Operations oversee logistics and inventory, impacting cost accounting. Procurement handles supplier relationships and contract negotiations, influencing accounts payable. Each department's actions have a direct impact on accounting processes and financial reporting, requiring close collaboration and efficient data sharing. Understanding the workflow in an e-commerce company helps in managing operations smoothly. Typically, it starts with product listing and progresses through customer order, payment processing, order fulfillment, and customer feedback. Each step involves specific accounting actions like revenue recognition, inventory adjustments, and cost allocations. This structured flow ensures efficient operations and accurate financial records, which are critical for strategic decision-making and maintaining customer satisfaction. E-commerce businesses like Flipkart engage with various stakeholders including clients, vendors, banks, and regulators. Clients drive revenue through purchases, while vendors affect inventory costs. Banks provide financial services necessary for transaction processing and capital management. Regulators ensure compliance with tax and trade laws. Each stakeholder interaction has distinct accounting implications, such as recording revenue, managing accounts payable, or ensuring legal compliance. This complexity requires precise accounting practices. E-commerce faces unique challenges like managing a fast-moving working capital cycle and complex contracts. Companies must maintain liquidity to handle rapid order flows, affecting cash management. Contracts with vendors often include variable pricing and return clauses, complicating revenue recognition. Regulatory requirements vary by region, requiring precise compliance management. Understanding these challenges is essential for accountants to ensure accurate financial reporting and strategic financial planning. Accounting in e-commerce requires handling vast data volumes and dynamic transactions, unlike traditional businesses. E-commerce accountants must manage digital sales data, process high transaction volumes, and deal with multi-currency operations. This involves implementing advanced software solutions for data accuracy and integrating systems for seamless information flow. These unique aspects require specialized knowledge and tools to ensure financial integrity and provide insights for strategic decisions. In an e-commerce setup like Flipkart, the accounting entries are typically passed by the finance team, triggered by key events like sales transactions, purchase orders, and payment processing. The finance team ensures compliance with accounting standards and accuracy in financial reporting. They collaborate with other departments to gather necessary data, enabling them to record transactions correctly and timely. This collaboration is crucial for maintaining the integrity of financial statements. We'll explore from order initiation to financial reconciliation. Understanding these detailed steps ensures accurate financial records and efficient business operations. You'll learn how each department's actions, from sales to finance, impact accounting. This section clarifies how transactions flow through systems, creating critical financial triggers. Let's dive into the systematic journey of an e-commerce transaction lifecycle. In Flipkart's e-commerce model, a customer places an order online. This action initiates the sales process, involving the sales and IT departments. The order details are captured in the order management system, and a sales order document is generated, triggering the need to check inventory. Potential issues include incorrect order data or system downtime, which can disrupt the process. Accurate order placement is crucial, as it sets off the inventory check and subsequent steps in the accounting process. The inventory management team checks stock availability in real time. They use the inventory management system, which synchronizes with the order management system. If stock is available, the system approves the order automatically. This step prevents overselling and ensures customer satisfaction. However, discrepancies in stock records or system errors can lead to approval delays. Accurate inventory data is vital to avoid back orders and maintain smooth order processing, affecting customer trust and financial accuracy. In this step, the warehouse team picks and packs the products. This involves using a warehouse management system, WMS, to ensure accurate order fulfillment. A packing slip is generated, and the items are prepared for dispatch. Errors like incorrect picking can cause customer dissatisfaction and returns. Proper order fulfillment is crucial for maintaining customer trust and ensuring revenue realization. The WMS communicates with the OMS to update order status, triggering shipping preparation. Once packed, the logistics team coordinates shipping. They use a logistics management system, LMS, to track packages. A shipping label is created, and the package is handed over to a courier service. This step is critical, as timely and accurate delivery impacts customer satisfaction. Mislabeling or delays can lead to customer complaints. The shipping confirmation updates the OMS, triggering the billing process. Efficient logistics ensure a smooth transition to invoicing and payment collection. After shipping confirmation, the finance department generates an invoice. The accounting software system pulls data from the OMS, creating a detailed invoice sent to the customer. Accurate invoicing ensures proper revenue recognition and customer payment. Mistakes like incorrect pricing or missing items can lead to disputes. This step is crucial as it impacts cash flow and financial statements. Proper integration between systems minimizes errors, promoting efficient financial operations. After invoicing, the accounts receivable team manages payment collection. Using a payment gateway system, they ensure secure transactions. Payment confirmation updates the accounting software system. Timely payments maintain cash flow and financial stability. Issues like payment gateway failures can delay cash inflows and impact operations. Efficient payment collection is crucial for maintaining liquidity and meeting financial obligations. The system must handle multiple payment methods to cater to diverse customer preferences. The finance team conducts reconciliation to ensure all transactions match records. They compare bank statements with internal records, resolving any discrepancies. Reconciliation ensures accuracy in financial reporting and prevents fraud. Errors like unrecorded transactions can lead to financial misstatements. This step is vital for confirming that all financial activities are recorded correctly, maintaining trust in financial statements. Regular reconciliation helps identify issues early, promoting financial health and transparency. In the final step, the accounting department completes the period close. This involves finalizing accounts, preparing financial statements, and ensuring compliance with regulatory standards. The process includes adjusting entries for accuracy and preparing reports for stakeholders. Errors during period close can affect financial transparency and compliance. This step is essential for providing stakeholders with a clear financial picture and for legal compliance. Effective period close ensures business continuity and strategic planning. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition is crucial for accurately reporting sales transactions. In e-commerce, it's governed by Indian Accounting Standard 115, which requires revenue to be recognized when control of goods is transferred to the customer. This means Flipkart must track when a product is delivered, not just when it's ordered or paid for. This differs from traditional retail accounting, where the point of sale is often the point of revenue recognition. Understanding this ensures that Flipkart accurately reports its financial performance. Inventory valuation is key to determining both the cost of goods sold and the ending inventory, impacting profitability. Indian Accounting Standard 2 governs this area, specifically important for e-commerce due to large SKU volumes. It mandates using FIFO or weighted average methods for inventory valuation, helping Flipkart to manage and report inventory costs accurately. This differs from smaller businesses that might use simpler valuation methods. Proper inventory valuation ensures Flipkart's financial statements reflect true costs and profitability. Fixed assets and depreciation involve allocating the cost of physical and intangible assets over their useful life. Governed by Indian Accounting Standard 16, it requires a systematic allocation method, which is critical in e-commerce where tech assets are significant. Flipkart, for instance, must account for servers and software, depreciating these assets as they contribute to revenue generation. This differs from industries with less technological dependency, highlighting the unique asset management challenges faced in e-commerce businesses. Deferred revenue is recorded when a payment is received before a service or product is delivered. Indian Accounting Standard 115 provides guidelines on the timing of revenue recognition, ensuring that revenue is only recognized once the service is completed or goods delivered. This concept is especially crucial for e-commerce platforms like Flipkart that offer subscription services, as it ensures revenue is matched with corresponding expenses and activities. This is more complex than in traditional retail, emphasizing careful management of customer payments. Foreign currency transactions occur when business activities involve multiple currencies, an everyday scenario for e-commerce giants like Flipkart. Indian Accounting Standard 21 governs these transactions, requiring them to be converted at the exchange rate on the transaction date, ensuring accurate financial reporting. This is vital as Flipkart deals with international suppliers and customers, unlike many brick-and-mortar retailers. Proper management of foreign transactions ensures Flipkart's financial statements reflect true economic effects, aiding in strategic decision-making. Provisions and contingencies deal with potential liabilities arising from uncertain events. Indian Accounting Standard 37 provides guidelines on when to recognize these provisions, specifying that they must be recorded when an obligation is probable and can be reasonably estimated. E-commerce companies like Flipkart face unique risks, such as data breaches, making this concept crucial. This differs from traditional retail, where physical risks are more prevalent. Proper management ensures financial resilience against unforeseen events, maintaining stakeholder trust. Cost allocation involves distributing costs across various products and services, crucial for developing effective pricing strategies. This process is vital in e-commerce to ensure products are competitively priced while maintaining profitability. It requires identifying direct and indirect costs, allowing companies like Flipkart to allocate expenses efficiently. This is more complex than in traditional retail due to the broader range of services offered online. Proper cost allocation helps Flipkart sustain market competitiveness and financial health. Segment reporting involves disclosing financial data for distinct business segments. Governed by Indian Accounting Standard 108, it requires companies to identify operating segments based on internal reporting structures. For e-commerce platforms like Flipkart, this means reporting segments such as electronics, fashion, and groceries. This is different from smaller retailers who might not segment their reporting. By using segment reporting, Flipkart can provide detailed insights to investors, aiding in more accurate performance analysis and strategic planning. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. The initial capital contribution entry reflects the inflow of funds from shareholders, which is essential for kickstarting operations. This entry increases the bank balance, representing available cash, and raises the share capital, indicating ownership equity. For an e-commerce giant like Flipkart, substantial initial capital is crucial to cover startup costs, invest in technology, and build a robust logistics network. Inventory purchases are recorded as assets because they represent future economic benefits. This transaction increases the inventory asset account, indicating goods available for sale. Simultaneously, the accounts payable liability account rises, reflecting Flipkart's obligation to pay suppliers. In e-commerce, maintaining inventory is crucial for meeting customer demand swiftly and efficiently. This transaction reflects a typical operational expense. Paying rent is crucial for maintaining physical office space, which supports various business functions. The rent expense account is debited, impacting profitability by increasing operating costs, while the bank account is credited, reducing cash reserves. Managing such expenses is vital for sustaining operational capacity and ensuring efficient business operations. Investing in technology significantly impacts Flipkart's competitive edge in e-commerce. This transaction enhances non-current assets by increasing the technology and equipment account, reflecting a commitment to long-term operational efficiency. The bank account decreases, showing cash outflow. Robust technology infrastructure supports enhanced user experiences, streamlines logistics, and optimizes supply chain management, critical factors for success in online retail. Revenue recognition is pivotal as it indicates earnings success. The accounts receivable account is debited, showing anticipated cash inflow from sales, while revenue is credited, boosting the company's profitability. For e-commerce businesses, timely and precise revenue recognition is crucial for financial reporting and strategic decisions, enabling Flipkart to assess market performance and adjust marketing or sales strategies accordingly. Collecting payments is a crucial cash flow activity, transforming accounts receivable into actual cash. The bank account rises, improving liquidity, while accounts receivable decreases, reflecting reduced credit risk. Timely collections are vital for maintaining cash flow, enabling Flipkart to reinvest in operations, pay liabilities, and fuel further growth initiatives. Efficient receivables management is key to sustaining a healthy financial position. Settling supplier payments is essential for maintaining good business relationships and ensuring a steady supply chain. This transaction decreases accounts payable, reducing liabilities, and decreases the bank account, indicating cash outflow. Prompt payments can secure favorable terms with suppliers and prevent disruptions in inventory availability, enabling Flipkart to maintain competitive product offerings and customer satisfaction. Marketing expenses are crucial for driving sales and building brand awareness. This entry debits the marketing expense account, adding to operating costs, while the bank account is credited, reflecting cash outflow. For e-commerce businesses like Flipkart, investing in marketing helps attract and retain customers, boost sales volume, and enhance market presence, ultimately contributing to long-term profitability and brand loyalty. Depreciation reflects the gradual consumption of asset value over time. This entry spreads the cost of technology assets over their useful life, aligning expenses with revenue generation. Depreciation expense is debited, impacting profitability, while accumulated depreciation is credited, reducing the asset's book value. Accurate depreciation accounting is vital for e-commerce firms like Flipkart to reflect true asset usage in financial statements and make informed investment decisions. Year-end inventory adjustments ensure that the financial statements reflect the actual inventory available. Adjusting the inventory account impacts the cost of goods sold, which directly affects the gross profit. This adjustment helps Flipkart accurately assess inventory management efficiency and aligns the financials with physical stock counts, crucial for budgeting and strategic planning to minimize holding costs and avoid stockouts. In this section, we will go through all the key concepts of financial statement impact in detail with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Current assets on the balance sheet, like cash and accounts receivable, represent resources Flipkart can use or convert to cash within a year. Increased inventory and prepaid expenses reveal operational investments to meet demand. These changes indicate liquidity and operational efficiency, crucial for e-commerce firms managing rapid sales cycles. Monitoring these helps assess short-term financial health and ensure the company can cover liabilities without selling long-term assets. Non-current assets such as property and intangibles are vital for Flipkart's sustained growth, as they support infrastructure and brand value. Meanwhile, Liabilities like long-term debt and deferred taxes impact the company's leverage and future cash flow. These elements reflect Flipkart's strategic investments and financial obligations, influencing its capital structure and risk profile. Understanding these helps stakeholders evaluate the company's long-term solvency and investment potential. Revenue growth indicates Flipkart's market expansion and customer acquisition success. Direct costs, captured in cost of goods sold, reflect expenses directly tied to sales. The difference between these, gross profit, reveals the company's efficiency in managing production and procurement. High gross profit margins can signal strong pricing power and cost control, essential for Flipkart's competitive positioning in the e-commerce market. Tracking these metrics is key to understanding profitability trends. Indirect expenses, like selling and administrative costs, impact Flipkart's EBITDA, a key performance measure excluding interest, taxes, and non-cash items. Effective expense management can enhance EBITDA, reflecting operational efficiency. Profit before tax highlights the company's profitability after all expenses excluding taxes. For e-commerce businesses, maintaining robust profit before tax margins is crucial for reinvestment and growth, ensuring long-term competitiveness. Analyzing these figures helps assess operational effectiveness and strategic positioning. Operating cash flow indicates Flipkart's efficiency in generating cash from core activities, vital for sustaining operations. Investing cash flow, often negative, reflects capital expenditures for growth and capacity expansion. Financing activities reveal capital structure changes, such as borrowing or equity issuance, impacting liquidity and financial flexibility. For e-commerce firms, balancing these cash flows ensures sufficient capital for innovation, expansion, and meeting financial obligations, critical for maintaining competitive advantage. Key financial ratios provide critical insights into Flipkart's performance. The current ratio assesses liquidity, ensuring the company can meet short-term liabilities. Return on equity measures profitability from shareholders' perspectives, reflecting management effectiveness. The inventory turnover ratio gauges how efficiently inventory is managed, crucial for e-commerce firms with large product ranges. Lastly, the debt-to-equity ratio indicates financial leverage and risk, important for evaluating long-term financial stability. Analyzing these ratios helps stakeholders make informed decisions. In this section, we will go through all the key concepts of common errors in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Misreporting and audit findings occurs when inaccuracies are found in how audit results are documented. These errors can arise from weak internal controls or a lack of robust audit processes, impacting the credibility of financial statements. For a company like Flipkart, this could mean misstating revenue from online sales or failing to properly account for expenses. Detecting such errors requires auditors to meticulously compare reported figures with actual transactions and ensure that internal controls are effective, thereby maintaining financial integrity. Interview traps and accounting roles can lead candidates to overstate their expertise or misinterpret common accounting scenarios. In the e-commerce industry, specific knowledge about digital sales and tax implications is crucial. Such traps often happen due to inadequate preparation or misunderstanding the job's technical requirements. Addressing this requires candidates to thoroughly understand the company's accounting systems and industry-specific challenges. From an interviewer's perspective, crafting precise questions that test real-world application rather than textbook knowledge can help avoid mismatches. ERP system configuration mistakes can lead to significant data inaccuracies. These often occur when the system is improperly set up or when the business processes are inadequately mapped to the ERP functions. For Flipkart, this could mean incorrectly processing sales data or mishandling inventory records. Correcting such errors involves thoroughly aligning the ERP system with the company's operational processes and conducting regular audits to ensure data integrity. Auditors would typically detect these mistakes by tracing discrepancies between system outputs and actual transactions, highlighting the need for accurate configurations. Cutoff errors in e-commerce occur when transactions are recorded in the wrong accounting period. This often happens due to delays in processing or recording sales and purchase transactions. For instance, sales made in December but recorded in January, can misstate revenue and expenses, affecting year-end financial accuracy. These errors arise from inefficient transaction recording systems. Correcting them requires companies like Flipkart to enforce strict cutoff procedures, ensuring that all transactions are recorded in the correct accounting period. Auditors detect these errors by reviewing transaction dates and matching them against the recorded entries. Standard switching errors occur when a company inconsistently applies different accounting standards. This often results from misunderstandings of new regulations or changes in accounting frameworks. For an e-commerce giant like Flipkart, this could mean inconsistencies in revenue recognition or inventory valuation, leading to misleading financial statements. The solution lies in continuous training of accounting personnel and strict adherence to a selected set of standards, such as International Financial Reporting Standards or Generally Accepted Accounting Principles. Auditors can catch these errors by reviewing financial policies and comparing them with reported data for consistency and compliance. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition under Indian Accounting Standard 115 for e-commerce involves recognizing revenue when control of the goods or services transfers to the customer. For Flipkart, this typically occurs when the product is delivered and the customer has accepted it. This ensures that revenue reflects the actual sale completion, aligning with the principle of recognizing revenue when earned and realizable. When a customer returns a product, Flipkart records a journal entry to reverse the initial sale. This involves debiting sales returns and allowances and crediting accounts receivable or cash. This entry adjusts revenue to reflect only completed sales and provides a clear picture of net revenue, crucial for accurate financial reporting and maintaining inventory records. Prepaid expenses in Flipkart's books are initially recorded as assets because they represent future economic benefits. Flipkart would debit a prepaid expense account and credit cash or accounts payable. As the benefit is consumed, they adjust by debiting the appropriate expense account and crediting the prepaid expense account, ensuring expenses are matched with the revenues they help generate. Discounts reduce the amount of revenue recognized from sales. In Flipkart's financials, discounts are deducted from gross sales to arrive at net sales. This impacts the income statement by decreasing total revenue and possibly net income. Accurately reflecting discounts is essential for portraying true sales performance and for decision-making regarding pricing strategies. Flipkart uses ERP systems to streamline inventory management by integrating real-time data from sales, returns, and supply chain operations. This system tracks stock levels, order status, and predicts future inventory needs, optimizing turnover and reducing excess stock. By automating these processes, ERP systems enhance accuracy and efficiency, crucial for meeting customer demand promptly and reducing holding costs. Indian Accounting Standard 115 and International Financial Reporting Standards 15 are largely aligned, both focusing on a 5-step model for revenue recognition. However, minor differences lie in the implementation guidance and illustrative examples specific to Indian regulatory and business environments. For Flipkart, these differences may influence how specific transactions are treated, particularly in multi-element arrangements, ensuring compliance with local standards while maintaining global reporting consistency. When Flipkart sells digital goods, revenue is recognized when the customer gains control over the good, often at the point of download or activation. If Flipkart acts as an agent, only the net commission is recorded as revenue. This distinction ensures that revenue accurately reflects the company's role in the transaction, crucial for financial transparency and strategic planning. To manage cash flow, Flipkart needs to optimize both receivables and payables. Offering discounts for early payments can expedite cash inflows, while negotiating extended payment terms with suppliers can delay cash outflows. Effective inventory management also minimizes cash tied up in stock. These strategies ensure liquidity for operational needs and investment opportunities, vital in the fast-paced e-commerce sector. If Flipkart fails to deliver a product, the deferred revenue remains a liability until fulfillment. This reflects Flipkart's obligation to either deliver the product or refund the customer. The failure impacts financial statements by overstating liabilities and affects cash planning. Recognizing this ensures accurate financial reporting and maintains trust with customers and stakeholders, highlighting the importance of fulfillment efficiency. International transactions introduce complexities like currency exchange differences, varying tax jurisdictions, and diverse regulatory compliance. Flipkart must manage foreign currency risk, possibly using hedging strategies, and ensure accurate tax reporting for each jurisdiction. Recognizing revenue across borders necessitates understanding local accounting standards, impacting how transactions are recorded and reported, maintaining global operational efficiency and compliance. Understanding Flipkart's business model involves recognizing the marketplace dynamics, where they facilitate transactions between buyers and sellers. They earn mostly through commissions and fees. An efficient supply chain and diverse payment options are vital to ensure smooth operations. Their inventory strategy balances own and vendor-managed stocks. Customer service is key to maintaining trust, while technology plays a crucial role in personalizing shopping experiences. In e-commerce accounting, recognizing revenue when customers gain control of goods is crucial. Cost of goods sold affects gross profit, recorded upon sale. Handling returns involves setting up reserves, anticipating future returns. Commission income is recognized as sellers make sales. Inventory valuation follows a conservative approach, ensuring it's recorded at lower of cost or market value. Advertising expenses, crucial for sales, are expensed immediately, reflecting their direct impact on revenue. Preparing for an e-commerce interview involves understanding key performance metrics like GMV and CAC. Proficiency in ERP systems is crucial for effective financial management. Awareness of regulatory compliance, especially GST, is essential. Data analysis skills can provide strategic insights, enhancing competitive edge. Efficient inventory management minimizes costs and prevents stockouts. Finally, focusing on customer experience ensures higher retention rates, making it a critical aspect of sustaining business growth. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to CandiMentor for more finance and accounting videos. We will see you in the next one.